CoreWeave, ticker CRWV. If you've been tracking the AI infrastructure space at all, you definitely know this name. But here's the crazy situation we find ourselves in right now. The stock is actually down 20% over the last 3 months, and yet analysts are out there still projecting a massive 65% upside. And with their incredibly high-stakes earnings report dropping in literally less than 48 hours, the tension out there is palpable. Welcome to The Explainer. Today we're diving deep into the technicals, the massive divide on Wall Street, the absolute gambling happening in the options market, and the single all-important number that matters way more than headline revenue.
So let's unpack this. We are looking at some of the most wildly contradictory signals of the entire year. Is this a brilliant, once-in-a-year buying opportunity right before a massive rebound? Or are we staring down a classic value trap just waiting to spring shut on investors?
Just think about this paradox for a second. A 65% projected upside. I mean, the stock has been visibly struggling, taking a 20% hit over a 3-month stretch and only just slightly recovering from a recent low of about $69.99. Yet the professional projections are incredibly, almost aggressively optimistic. So how in the world do we actually reconcile that?
To really understand the stakes here, let's look at where things currently stand. The stock is trading right around $91.70, which is up about 7% just this week. But you've got to look at that beta figure, 2.58. For those of you tracking the metrics, you know that means CoreWeave moves nearly 2.6 times the broader market. This is not some slow, steady climb. This stock is an absolute roller coaster ride. If the broader market sneezes, CoreWeave catches a severe cold. But if the market rallies, CoreWeave blasts off like a rocket.
Okay, looking at the technicals to see how this builds our picture, the mixed signals here are just striking. On one hand, you've got the stock trading above its 20-day moving average of $78, giving us a pretty solid bullish signal in the short term. But pull back just a little bit, and it is still stuck below its 60-day moving average near $96. That makes the intermediate trend decidedly bearish. And the indicators, the ADX and MACD, are screaming buy, while oscillators like the CCI and stochastic are flashing sell. Basically, the market is entirely undecided, meaning this upcoming earnings report is going to be the ultimate deciding trigger.
Section 1. Wall Street is divided. Massive disagreement.
So the overall consensus sits at a moderate buy, with an average target of around $136. But look at the sheer extremes sitting underneath that average. On the ultra-high end, Rosenblatt is targeting $250. That is nearly triple today's price. But on the low end, HSBC has a target of just $32. That is a devastating 65% downside. When highly paid analysts are this incredibly far apart, it means nobody actually agrees on what this company's really worth.
And you know, the contradictions really don't stop there. Over the last 2 weeks, we've seen a massive flurry of upgrades. Deutsche Bank at $150, Citi at $142, Piper Sandler at $151. So institutional money is clearly leaning bullish ahead of the print. But I found a massive catch. Insiders have been selling. Specifically, CoreWeave's chief accounting officer sold off shares back in May. Now, to be fair, insider selling isn't automatically a death knell. People sell for personal reasons all the time. Buying a house, taxes, whatever. But right before a critical growth phase, it certainly isn't a ringing vote of confidence either.
Moving on to Section 2, Options Market Gambling, High-Stakes Bets.
Right now, implied volatility is sitting at an eye-watering 101%. The market is pricing in a massive 12 to 15% move immediately following the earnings release, and that's in either direction. You can literally see the tug-of-war happening behind the scenes. On August 3rd, call volume saw a huge spike. 300,000 contracts traded, which is 31% above the average. That's a huge sign of retail traders and hedge funds betting heavily on a massive upside surprise. But simultaneously, the put/call ratio has been steadily climbing. More and more traders are grabbing puts for downside protection. The market is hedging both ways, which means frankly this isn't investing right now, it's high-stakes gambling ahead of the print.
All right, Section 3, the fundamental elephant, looking at the numbers. Let's walk through these stark contrasts together because they are something else. On the top line, things look absolutely incredible. Q1 revenue came in at $2.08 billion. That's a blistering 111% growth year over year. But drop down just one line. A net loss of negative $740 million. They burned through nearly $750 million in a single quarter. Ouch! Why? Well, because they are spending like crazy. Planned capital expenditures are sitting between $31 and $35 billion. And because of that massive spend, their margins are completely squeezed down to a razor-thin 1%. Then you look at the balance sheet. $35.1 billion in debt, and a quick ratio of just 0.31. To put that 0.31 in plain English, they currently cannot cover their short-term liabilities with liquid assets. If financing costs suddenly tick up, they are in immediate trouble.
So the ultimate debate surrounding this stock is laid out perfectly right here. The bull case essentially argues that AI demand is entirely insatiable right now, and CoreWeave is just aggressively building the vital infrastructure needed to capture that once-in-a-generation boom. The bear case? Well, they look at the exact same data and say CoreWeave is burning cash, drowning in an ocean of debt, and trying to compete against established hyperscalers like AWS and Azure, who just have infinitely deeper pockets.
And that fierce, ongoing debate has led to a highly targeted stock. Somewhere between 18% and 27% of CoreWeave's float is currently shorted. Why this matters comes down to simple market mechanics. With a quarter of the available shares sold short, if CoreWeave comes out and delivers a massive positive earnings beat that forces those shorts to cover, we could see a huge, rapid short squeeze that sends the stock price completely vertical.
Which brings us to Section 4, the deciding metric, the number to watch.
I want you to forget the flashy top-line revenue numbers for just a second. This right here is the ultimate metric that will completely decide the fate of this report. $99.4 billion. That was CoreWeave's reported revenue backlog last quarter. Now, revenue backlog is future contracted revenue. It is absolutely the most critical number to watch. If that $99.4 billion figure grows this quarter, it signals to Wall Street that the underlying demand is not just some flash in the pan. It proves the demand is real, it's sticky, and those massive capital expenditures totally justified.
But alongside that backlog, we have to keep a very close eye on customer diversification. Right now, a handful of massive clients, primarily NVIDIA and Meta, are driving the vast majority of CoreWeave's business, and having that much concentration is a huge risk. If they can get on the earnings call and actually name-drop new, major enterprise clients, proving they're expanding their ecosystem, that would act as a massive positive catalyst for the stock. So when the numbers finally hit the wire, here is exactly what we should be watching for. First, that revenue backlog growth we just talked about. Second, CapEx guidance updates. If CoreWeave signals they are finally pulling back on spending to protect their margins, the stock could rally hard as investors breathe a collective sigh of relief. But if they double down on the $35 billion spend, expect some serious pain. And finally, watch the post-print price action itself, not just the headline numbers.
Because objectively, we're looking at two very, very extreme scenarios here. If earnings beat and that backlog grows, remember that heavily shorted float, a short squeeze could easily send the stock rocketing to $120 incredibly quickly. On the flip side, though, if they miss or if they guide lower while sitting on $35 billion in debt, the floor could literally fall out, sending the stock tumbling down to $70 or even lower. The execution risk here is just immense.
Bottom line, CoreWeave is a high-stakes bet on the future of AI infrastructure. The growth is undeniably real, for sure, but the execution risk is massive. August 11th is going to be a make-or-break moment for this entire company. So I'll leave you with this. Looking at that exploding debt versus the completely insatiable demand for AI, are you bullish or bearish on CRWV? Think about how you weigh those conflicting signals. Thanks for joining me for this explainer, and I'll catch you in the next one.